When you're trying to understand what's happening in the crypto and financial technology space right now, you need to understand one fundamental reality. The world's most powerful financial infrastructure is being rebuilt from the ground up, and blockchain technology is becoming the foundation of this transformation. This isn't speculation or wishful thinking from crypto enthusiasts. This is happening at the highest levels of Wall Street, with institutions that literally move trillions of dollars in transactions every single day stepping into the digital asset space in ways that were unimaginable just a few years ago. The convergence of XRP, the Canton Network, and the Depository Trust and Clearing Corporation represents one of the most significant developments in financial infrastructure modernization that few people are actually paying attention to, and understanding this connection could be crucial to understanding where the entire digital asset ecosystem is headed. The Depository Trust and Clearing Corporation, or DTCC, is essentially the backbone of the entire U.S. securities market. To put this in perspective, DTCC's subsidiaries process securities transactions valued at approximately 3.70 cents quadrillion in 2024 alone. That's not billion, not trillion, but quadrillion. The depository subsidiary provided custody and asset servicing for securities issues from over 150 countries and territories, valued at approximately $99 trillion. This isn't just a financial company. This is the infrastructure that every major stock trade, bond transaction, derivative exchange, and treasury security settlement in the United States passes through. When DTCC moves, the entire financial system feels it. When DTCC innovates, it signals that the entire industry is about to shift in a particular direction. For decades, DTCC operated using legacy systems that were built in earlier eras of financial technology, systems that required multiple intermediaries, lengthy settlement times, and complex procedural workflows that haven't fundamentally changed in decades. But something remarkable started happening in 2024 and 2025, and it represents a turning point that should capture everyone's attention. In December 2025, DTCC announced a strategic partnership with Digital Asset Holdings and the Canton Network to enable the tokenization of DTC custodied assets, starting with U.S. Treasury securities. This wasn't a small pilot program or a minor exploratory project. This was an official announcement following DTCC's receipt of a no-action letter from the Securities and Exchange Commission, which explicitly allows DTCC to implement and operate a new service to tokenize real-world DTC custodied assets. The announcement represents the first major step in what DTCC itself describes as a broader strategy to make DTC custodied assets available on-chain. The organizations involved are targeting a minimum viable product in a controlled production environment during the first half of 2026, with plans to expand the size and scope of the project in subsequent months based on client interest. When you have the SEC giving explicit written permission, when you have DTCC stepping into this space officially, when you have the largest financial clearinghouse in the world saying it's going to tokenize securities, this signals that institutional adoption of blockchain technology has entered a new phase entirely. The Canton Network is a privacy-enabled permissioned blockchain that was specifically designed to address a problem that had plagued blockchain adoption in regulated finance for more than a decade. Most public blockchains operate on the principle of complete transparency. Transactions are visible to everyone, positions are public, and all activity flows through a mempool that the entire network can observe. This works fine for permissionless systems designed for global cryptocurrency trading, but it creates an absolute barrier to adoption for regulated financial institutions that cannot publicly expose their positions, their counterparties, their liquidity movements, or their internal operations. Canton solved this fundamental architectural problem by building a blockchain that allows financial institutions to transact on-chain while maintaining granular control over data visibility. Participants can determine which counterparties and service providers can view specific transaction information rather than broadcasting activity to the entire network. This privacy by design approach, combined with institutional-grade compliance capabilities, made Canton the perfect choice for DTCC's tokenization initiative. The Canton Network was created by Digital Asset, a firm that has backing from some of the most powerful Wall Street institutions on the planet, including BlackRock, Blackstone, NASDAQ, S&P Global, Goldman Sachs, and Citadel Securities. These aren't casual investors or speculative venture funds. These are the firms that control trillions in assets and set the standards for the entire financial industry. The fact that these institutions back digital asset and its Canton Network long before DTCC's official announcement demonstrates that there's been serious coordination happening behind the scenes for years. Now, with DTCC's official partnership announcement, Canton Coin, the network's native token, has surged in value, and the network is being recognized as the leading infrastructure platform for institutional real-world asset tokenization. The active addresses on Canton Network have grown substantially, with recent data showing nearly 24,000 active ADD. RES is executing over 500,000 transactions, suggesting genuine network engagement rather than speculative hype. But here's where the story gets really interesting, and where XRP enters the conversation in a way that most people haven't fully appreciated yet. DTCC has filed multiple patents that explicitly name XRP and Stellar's XLM as components of future financial infrastructure systems. One patent titled Systems, Methods, and Storage Media for Managing Digital Liquidity Tokens in a Distributed Ledger Platform outlines a comprehensive framework for tokenizing liquidity across various asset classes while integrating digital assets like XRP and XLM. This patent describes a system where digital liquidity tokens represent ownership in market-making functions between two assets, and where multi-chain transactions are executed using a sophisticated system of bridge nodes representing entry and exit points on supported blockchains. The system uses zero-knowledge proofs and an ontology layer that converts generic instructions into chain-specific formats, creating a programmable, compliant infrastructure for liquidity provisioning that scales across networks and jurisdictions. This isn't just speculation about DTCC interest in XRP. This is official patent documentation that explicitly details how XRP could be integrated into DTCC's operational framework. Another related patent filed by DTCC focuses on hierarchical rights delegation, wallet control structures, and secure identity management using what the patent calls root and delegate structures. Together, these patents form what appears to be a comprehensive dual-pillar strategy where one patent defines how assets flow and earn value on a multi-chain infrastructure, while the other governs who controls them and under what rules they operate. Both patents reference multi-chain ecosystems and explicitly mention compatibility with XRP, XLM, and Hedera hash graph. This is deeply significant because it suggests that DTCC's vision for the future financial infrastructure involves these networks working together as part of an interoperable system, not competing separately. When you combine these patents with DTCC's Canton Network partnership, you're looking at a picture where DTCC appears to be building multiple layers of infrastructure, some using the privacy-enabled Canton Network for direct institutional settlement, and other layers that could leverage purpose-built payment networks like XRP for cross-border liquidity and settlement. To understand why XRP specifically might play a unique role in this ecosystem, you need to understand what makes XRP Ledger fundamentally different from other blockchain networks. Ripple's Senior Vice President Marcus Infanger has argued that the XRP Ledger is built for the next phase of real-world asset tokenization and represents what comes after the current generation of infrastructure that relies heavily on special-purpose vehicles and legacy custody models. He points out that the XRPL includes built-in features specifically designed for financial use cases from the very beginning: a native decentralized exchange, an automated market maker, and lending vault standards that were designed into the protocol itself, rather than bolted on afterward. This is fundamentally different from adding DeFi features to a smart contract platform that was originally designed for general-purpose computation. The XRPL was purpose-built for financial settlement, asset issuance, and payment routing, which means less integration work and potentially lower operational risk for institutions moving from traditional systems toward native issuance on a blockchain. A particularly compelling example of this XRPL capability is a pilot program that was completed in July 2025 in Volvi. A broad industry group that achieved live 24/7 trading and near-instant settlement of tokenized U.S. Treasury securities directly on the Canton Network using blockchain infrastructure. The participants successfully executed on-chain intraday and after-hours financing, achieving atomic settlement outside of traditional market hours, something that's virtually impossible with current settlement infrastructure. Multiple transactions were completed entirely on-chain, with repos executed and settled in real time even over weekends using multiple stablecoins and demonstrating the reuse of collateral across different applications. This wasn't theoretical work, this was institutional-grade infrastructure already handling real market conditions and proving that settlement could happen at speeds and in configurations that legacy systems simply cannot match. When you can achieve intraday settlement, when you can complete transactions outside of traditional market hours, when you can execute atomic swaps of complex financial instruments with built-in compliance and privacy, these are fundamental advantages that will drive adoption. The concept of tokenization itself represents a paradigm shift in how financial assets are structured and settled. Instead of relying on centralized custodians and complex settlement procedures where ownership records exist in one place and actual assets exist in another, tokenization allows the asset itself to be a digital token that lives on a blockchain, carrying with it all the compliance requirements, settlement logic, and ownership history embedded directly in the code. This fundamentally changes the economics of finance. Settlement can happen in seconds rather than 2 or more days. Collateral can be reused instantly across different applications and counterparties. Liquidity can flow directly from buyer to seller without passing through multiple intermediaries, each taking fees and adding delays. Real-world assets worth trillions of dollars, government bonds, corporate debt, mortgages, equity ownership, commodities, could eventually exist as tokenized instruments, and that's where the $10 trillion opportunity comes from that some analysts are discussing. This isn't about replacing the current financial system with crypto, it's about modernizing the current financial system using the same underlying technology that powers crypto. When Charles Hoskinson, the founder of Cardano, observed that networks like XRP and Cardano were built from the very beginning with the explicit purpose of handling decentralized finance and institutional scale asset issuance, while traditional finance firms like DTCC and Digital Asset are trying to adapt existing blockchain technology to institutional constraints, he was pointing to a fundamental architectural difference. He suggested that legacy finance is recreating systems that have already been built into crypto-native networks, but doing so at a smaller scale and with more constraints. This raises an important question. Will institutions eventually discover that purpose-built crypto-native systems like XRPL are actually more efficient than adapted systems, even if those adapted systems have institutional governance and Wall Street backing? Or will the institutional oversight, regulatory clarity, and compliance by design approach of Canton-based systems prove superior to permissionless alternatives? The answer likely involves both approaches serving different purposes. Canton might handle internal institutional settlement and highly regulated assets. XRP or XRPL might handle the liquidity, routing, cross-border payments, and connections between different institutions and jurisdictions. Stellar might handle remittances and unbanked populations rather than winner-takes-all, MIG. See a multi-chain future where different networks handle different pieces of the infrastructure because they're purpose-built for their particular use case. The regulatory environment has shifted dramatically in favor of this entire ecosystem during 2025. The SEC's no-action letter to DTC explicitly permits DTCC to implement and operate a tokenization service for real-world DTC custodied assets. This is huge because it means the SEC has essentially blessed this entire category of activity and given a clear green light for institutions to proceed. Additionally, Ripple settled its long-running legal battle with the SEC for $125 million in August 2025, establishing regulatory clarity around XRP that had been missing for years. Multiple XRP spot ETFs were approved and listed under DTCC's active and pre-launch categories in November 2025. XRP ETF inflows have surpassed $1 billion, demonstrating significant institutional interest in accessing XRP through traditional investment vehicles. Ripple has secured conditional approval to operate under a banking license, giving it regulatory status that positions it more like a traditional financial services company. These regulatory developments represent a sea change. The infrastructure is no longer operating in gray areas or pushing against regulatory boundaries. It's operating with explicit permission and regulatory blessing. The implications of DTCC, Canton Network, and XRP working together as part of a modernized financial infrastructure are profound, even if the connections haven't been formally announced with explicit partnership statements. DTCC's patents naming XRP suggest consideration for future implementation. The phased approach DTCC announced, targeting an MVP in early 2026 with plans to expand based on client interest, suggests that this is just the beginning. If institutional clients demand certain capabilities, if they need cross-border liquidity solutions that XRPL excels at, if they need connections to other blockchain networks that the patent's multi-chain architecture describes, then XRP could be integrated into the ecosystem as part of a broader infrastructure play. The fact that DTCC CEO Frank Lasala emphasized that this tokenization initiative would eventually expand to a broad spectrum of DTC-eligible assets across network providers suggests that multiple blockchain networks will eventually be plugged into this infrastructure, not just Canton.br. His scale of opportunity here is almost incomprehensible. Current value of tokenized real-world assets has grown sharply, with U.S. Treasury securities alone representing a major expansion category. But DTC-eligible assets extend far beyond treasuries. They include corporate bonds, municipal bonds, equity securities, derivatives, commodities, funds, structured products, and complex financial instruments. The total value of assets custodied through DTC exceeds $99 trillion. If even a fraction of these assets eventually migrate to tokenized infrastructure, if settlement times compress from days to seconds, if collateral efficiency improves dramatically through instant reuse, the economic value created would be extraordinary. Banks and financial institutions would be able to process more transactions with fewer resources. Liquidity would improve because assets could move instantly rather than waiting for settlement windows. Price discovery would improve because transactions could execute in real time across multiple venues without settlement delays, creating artificial asynchronous. The role that XRP could play in this infrastructure relates specifically to one of the fundamental challenges of a tokenized financial system. How do you handle settlement and liquidity routing across different networks and jurisdictions? You need a non-settlement currency. You need a bridge token. You need something that can move instantly with minimal fees and near universal acceptance. This is exactly what XRP was designed to do. XRP was purpose-built as a settlement asset for financial institutions to use for cross-border payments and liquidity provisioning. The XRP ledger's unique features, like the ability to send multiple currencies in a single transaction with built-in exchange, the native decentralized exchange functionality, and the ability to execute cross-currency transactions atomically, make it ideally suited for this role. In a future where multiple blockchain networks are running different applications and assets, XRP could be the settlement layer that ties everything together. It could be the asset that institutions hold for liquidity reserve purposes the way they currently hold foreign currencies or cash equivalents. When you look at DTCC's 2024 transaction volume of $370 quadrillion annually, you begin to understand the scale of the opportunity. That's roughly $10 billion in transactions per day. If a small percentage of settlement activity eventually flows through XRP-based infrastructure, even at tiny fees per transaction, the volume and value moving through the network would be staggering. If institutions adopt XRP as a settlement reserve currency to minimize friction in a tokenized asset landscape, the demand for XRP could be substantially higher than current levels. This is why some analysts in the community are discussing long-term price targets for XRP that seem almost absurdly high, because they're calculating scenarios where XRP becomes fundamental infrastructure within a multi-trillion-dollar ecosystem. These aren't predictions, they're conditional analyses exploring what could happen if certain institutional adoption scenarios play out. However, it's crucial to understand that while e-patents and the Canton Network partnership suggest strong institutional interest in blockchain-based financial infrastructure, nothing is guaranteed. DTCC could ultimately decide that a proprietary blockchain built specifically for its members serves its purposes better than integrating multiple public networks. Regulatory constraints could emerge that prevent XRP or other crypto assets from playing settlement roles in regulated markets. The current political and regulatory environment could shift. Established financial institutions could develop and prefer their own solutions. The advantage of DTCC announcing a phased approach with intentions to expand is that it demonstrates confidence, but the actual execution will determine whether this transformation happens as quickly as some in the community anticipate. The fact that DTCC is targeting an MVP in the first half of 2026 suggests that real implementation is imminent, not years away, but there will still be technical, regulatory, and market challenges to overcome. The competitive landscape is also worth understanding. Canton Network isn't the only privacy-enabled blockchain being developed for institutional use. Hedera Hashgraph has institutional backing and its own set of advantages. Various traditional finance firms and central bank digital currency projects are exploring alternatives to public blockchains. The fact that DTCC selected Canton for the initial treasury tokenization project suggests confidence in that platform, but DTCC's explicit language about eventually expanding across network providers indicates that the infrastructure vision involves multiple networks. There's enough opportunity in a $10 trillion plus RWA market to sustain multiple successful platforms and multiple settlement layers. Canton might dominate the institutional asset issuance space while XRP handles settlement and liquidity routing. Hedera might dominate a different segment. Traditional financial firm blockchains might handle specific use cases. The future doesn't require one winner. It allows for a differentiated ecosystem where different networks excel at different purposes. The implications for XRP specifically extend beyond just the financial infrastructure play. Ripple's efforts around the XRP ledger's capabilities, the partnerships that RippleX has been building, the work around custody solutions for institutions, all of this is positioning XRP and XRPL as a comprehensive solution for real-world asset tokenization, from issuance to settlement to custody to trading. If institutions begin to see the XRPL as a preferred infrastructure for issuing and managing tokenized assets, that becomes a network effect that strengthens over time. Developers build tools for the XRPL because institutions are demanding XRPL solutions. Liquidity pools on XRPL deepens because more transactions need to settle there. Partnerships expand because institutions want integrated solutions that include XRPL native components. This is how network effects work in blockchain infrastructure, and it's why the foundational architectural advantages of XRP Ledger become increasingly important as the ecosystem scales. The broader crypto market has been somewhat disconnected from these institutional infrastructure developments during much of 2025, with most major Layer 1 tokens experiencing price pressure even as their fundamental adoption metrics and institutional participation increased. This divergence between network usage and token price performance suggests that markets haven't fully priced in the significance of developments like DTCC's tokenization initiative or the regulatory clarity that emerged around XRP and other infrastructure-focused tokens. There's a reasonable case to be made that once institutions actually begin implementation of these tokenization systems, once they start requiring XRP for settlement activities, once they begin integrating XRPL infrastructure into their operations, the market will eventually recognize the fundamental value of these infrastructure networks. The historical precedent exists. Bitcoin and Ethereum have experienced massive rallies following periods where adoption metrics surged, but price action lagged. The timeline from here becomes crucial. DTCC's MVP targeting first half of 2026 means we're looking at real testable infrastructure that institutions will interact with within roughly 12 months from now. The outcomes of these pilots will inform whether DTCC and digital asset accelerate expansion or encounter technical or regulatory obstacles that require reworking. If the pilots succeed, if institutions adopt the tokenization offerings readily, if the infrastructure proves stable and compliant, then the next phase of expansion could move quickly. Within 2 to 3 years, you could realistically see a percentage of DTC-eligible assets trading in tokenized form, settlement times dropping dramatically, and institutions requiring settlement infrastructure like what XRP can provide. Within 5 to 7 years, you could see a meaningful percentage of global financial assets existing as tokenized instruments. This isn't a speculative timeline. It's based on DTCC's own roadmap and statements. The role of smaller financial participants and innovation also shouldn't be overlooked. While institutional adoption is the initial focus, once tokenized assets infrastructure exists and proves reliable, smaller financial firms, fintech companies, international institutions, and emerging market financial systems will eventually want access to the same infrastructure. Why settle assets over days when they could settle over seconds? Why hold currency reserves in less efficient forms when tokenized assets could provide better yield and lower operational friction? Why maintain separate settlement systems for international transactions when a universal infrastructure could simplify everything? These fundamental questions will drive adoption not just among Wall Street firms, but throughout the global financial system. This is where the truly massive scale opportunity emerges. Not in serving the current $3.70 quadrillion that DTCC processes, but in modernizing settlement infrastructure globally across all asset classes and all financial institutions. Understanding the connection between XRP, Canton Network, and DTCC isn't just about predicting cryptocurrency price movements. It's about recognizing that the foundational infrastructure of global finance is being rebuilt. Decisions being made right now about which networks, which design approaches, which settlement methods will be used in tokenized finance will have implications that extend for decades. The institutions making these decisions, DTCC, Digital Asset, BlackRock, Goldman Sachs, NASDAQ, and others, aren't making speculative bets. They're making deliberate architectural choices about what infrastructure will serve the financial system in the digital era. The fact that DTCC patents name XRP, the fact that both Canton Network and XRPL-based infrastructure share fundamental advantages in handling institutional finance, the fact that the regulatory environment has shifted to permit implementation, all of this suggests that the pieces are aligning for a transformational shift in financial infrastructure. Whether it happens as quickly as some community members anticipate, whether XRP captures all the value that some analysts project, or whether institutional preferences shift in different directions remains to be seen. But the direction of travel is unmistakable, and this is definitely huge.